Hey guys, welcome back to another week where we talk about all things real estate related. Big topic that's going on in the news right now is the Bank of Canada once again increased the interest rates. So today I brought on my favorite mortgage broker here, Eric from Ottawa Mortgage Shop, to help answer some questions about what's going on.
How you doing?
Thanks for coming again, Eric.
You're welcome. You're welcome. So yeah, the Bank of Canada upped their rates by 0.50, making their benchmark rate 3.75, which means for everybody on a variable mortgage or looking at a variable mortgage, the prime rate increased to 5.95. And the Bank of Canada actually hinted that there might be another rate hike coming in December. So another announcement on December 7th. But we were, everybody was saying that they were going to up the rate by 0.75. We were surprised at 0.5. So I guess a little blessing in disguise, I guess.
Yeah, I think that was nice to see. I think the last couple of rate increases, we've been surprised by them being more than expected.
That's right.
So I think it has you a little bit of sigh of relief when we're seeing the other way. Maybe we're starting to see the increases come down a little bit.
Exactly.
So I guess really, if you're looking at a mortgage right now, what does this really mean to you?
If you're on a fixed rate, it doesn't change anything. And if you're on a variable rate, then you saw the rate go up a little bit more. Your payments might have changed a little bit. You're probably looking at a difference of maybe $25 a month for every 100,000 with this rate hike. So nothing too drastic, but still, people will feel it a little bit for sure.
Mm-hmm. I think we've done the math a little bit in the past, looking at what the rates were when they were lower versus the higher sale prices, and then now looking at what the market is, what things are selling for in the market right now versus the rates today.
Yeah, so we did calculations on March 2022, which is slightly before all the interest rate hikes, and we compared it to today to see how it looks on a monthly payment on a monthly payment with the new home prices that have been going down. So when we look at the slide from March 2022, the average home prices for Ottawa was $825,000. So if we calculate that with a $60,000 down payment, with the rate at the time was about 2.99 over 25 years, your monthly payments were $3,773 a month. Your balance after the 5 years was $682,127. Mm-hmm. Now, if you look at today, October, the average price of homes went down to about $650,000. So a big drastic change with a down payment that's now lower. So instead of $60,000, now it's $40,000. So for the people that are waiting to save up for a down payment, because of the new home prices, that has gone down. Your interest rate for 5 years is 4.89, and you're actually looking at a monthly payment, which is cheaper than what it was in March at $3,650. Now, another big thing is the balance after the 5 years is $560,000. So right there, because the home prices have gone down, and we all assume once the interest rates start going down a little bit more, the house pricing will go back up. So when you're looking at equity in the home, you're better off right now in October than you were in March.
Yeah, no, for sure. What I'm seeing right now, what we're getting for our buyers is we're doing a bunch of deals right now where the market is, gone down significantly, but there isn't buyers around right now, right? So we're seeing a lot less buyer activity. So the buyers have options. Back in March when all the sellers had the power, now our buyers are able to negotiate deals way below what the overall market value is, even at today's lower price, right? So I think the biggest factor there too is we're getting some really great deals for our clients, but I think if they have problems qualifying at the new rate, what are some options that people might have?
That's a good question. So qualifying rate, obviously when the rates go up, so does a qualifying rate, because right now we're going to be at 2% above what the rate that you're given. It takes a little bit off the qualifying, but because the home prices have gone down, it's a little easier to qualify. If you have 20% as a down payment, there are other options out there as, B lending or even private lending that can help you get into the market right away while the prices are low. And when you're looking at the rates for a B lender, it's not much difference than what you're going to see with regular banks. You're going to see maybe a difference of 0.50 added to the rate. And usually these B lenders will do like a 1 year or 2 year, which is perfect right now if we're foreseeing the rates going down in 18 months, 24 months. If you're going into the market now, you're getting a slightly higher interest rate on the B side, but you're in the market. The price houses will go up, and you've got in at the right time with a lower purchase price and a lot more equity in 2 years from now in your home. So you've got into the market, and you're benefiting from the lower price, and in 2 years from now, you're going to benefit from the lower interest rate. So it's like a win-win right now.
For sure. And what would be the difference for, say, a C lender? What exactly is a C lender?
Like a private lender will be, slightly higher interest rates. We're going to be looking at around the 7.5%. Sometimes it comes with a little bit of fees in there, but it gets you into the market. We see a lot more of that type of situation on the private side from, people that bought, a year and a half ago on the new builds. And now they're coming up to closing date and they can't find a mortgage. So they're kind of stuck because the qualifying rate has been going up and they didn't, keep up with their pre-approvals as well, right? So you're seeing a lot more on that B side. But sky's the limit when it comes down to the private side. You can use bad credit, no income, higher debt ratio. Anything can be done on the private side. The B lending, the other thing that I like is that they've actually increased the amortization, because it used to be 30 years, now it's 35, giving you a little bit more flexibility on your monthly payments and also on the qualifying as well. These types of lenders will let you go to up to 60% debt ratio. And if you're looking at the normal banks, it'll be 44. So if you're stuck in the qualifying aspect of the mortgage, there are options out there. They're not that expensive. You get into the market with a great purchase price, and in 2 years from now, you benefit from the lower rates.
And so do you see the A lenders changing the qualifying rate or the amortization schedule?
Everybody's hoping for it. We haven't heard much about the qualifying rate or the amortization since the rate hikes actually started. But yeah, it would definitely benefit, the buyers out there if the qualifying rate was a little lower than what it is now. If you're also seeing a lot of A lenders or even CMHC insured mortgages going from 25 years to 30 years, that'll help the qualifying as well. So hopefully there's something there that they're working on for the future to help a lot more people qualify for the mortgages.
All right, I think that answers some of my questions. But if people have more questions, how would they get a hold of you?
You can go on our website, ottawamortgageshop.com, or my number's here below the screen. We're always there to help. We answer our calls. The simplest question might save you thousands. So make sure that you're well informed. Give us a call, and we'll go through different options for you. Not every client has the same scenario, so drop us a line and we'll help you out.
Thanks again.
Thank you very much.